All right, 4:30. We're not living on Tulsa time. We're living on Eastern Standard Time. Thank you all for joining me today. Woo! Wow. What just when you think a 3-day holiday would clear the head and get you back in the swing of things, Putin goes and marches some tanks and a few thousand troops into Ukraine. Jeez. Welcome everybody. Which J? But if it's JA or JR, either way, both J's are great people. Thank you for saying hello. Bonnie, we're going to make today a very fast, rapid fire event, and we've got a pile of questions. And so, first and foremost, we're going to just go through the PUG disclosure, if you may. Take a second to read that small fine print, which means trading is risky. This is educational material. And we're going to rip right into not maybe the first question, but possibly the second question. And so, or shall I say, let's look at, for example, Bonnie's question. So, Bonnie, since she took the time to type in the question, we're going to answer her question. What happens when and if we stay in a low volume market? Do we change the indicators to compensate? Thanks. Um, it is not beyond today's scope of discussion, but what I will say is that the J person indicator, and we'll talk about person's user group and then also defining volume. We compare volume in a period, and generally speaking, Joe Granville's on balance volume indicator measures and assigns the daily value, negative or positive, to the day's movement. So directional movement, if it was up, all the volume is assigned to positive. If today's trade was a lower close, it would assign the trend negative. So that's where you get a trend mode out of uh, on balance volume. To me, this is a good indication that uh, which way is the money flow going. And so with that stated, what does volume represent? Money flow. It represents the people that are participating, or participation rate. What is the participation rate? Well, Bonnie, markets can move up on a dime in no volume. They can also go nowhere on no volume. So it's a measurement which is a better answer over a period of time, because we've seen these, the age old question, what comes first, the chicken or the egg? What comes first after a big wide range day or a big wide range month or a big volatile period? We go through a relaxation period. Maybe people are burnt out, right? The market's tired, participants are tired, there's nothing really, the news hasn't really changed, we're digesting an event. So whether it's an earnings play, whether it's the Federal Reserve adjusting interest rates, generally speaking, they until now or recently, and we still don't know because they haven't acted. Do they raise rates every 6 weeks at every meeting? And by the way, the Fed meets every 6 weeks. So what causes volume to shrivel? Risk is too great. People say, I don't want to trade this mess, or they have something better to do, or there's someplace else to go. So bottom line, Deb and Jay, it's the A couple, the A team. Hello, Jay. Thank you, and Deb. So Bonnie, bottom line is price can move, and so whether it's low volume or not, it's just a matter of it's a combination of using your volume indicator as well as price-based indicator, and that's where on balance volume, as well as my own tool, will be helpful to discover what the trend of the volume is, and what those trends represent. Is the market going up on a steady rising trend? Because some people might look at this rally as saying, after 1 or 2 days, and it's time and price. 1 or 2 days, there's no volume in there. 3 days, there's no volume in there. 4 days. So if I may be so bold, I'm going to go to insert, and I'm using 9.5 here, and I use 10.0 elsewhere. So insert analysis technique. It doesn't matter whichever trade. I'm just using TradeStation. It's the first one that's open because it's relevant to the next question. So let's just insert volume. So relative to history, what's a low volume period? This market was rising in a period of, well, relative to back in October. You could see the volume levels here were a lot lower according to the volume histogram than they were in this period when the market, and we got to compare an apple to an apple. As you can see, the rise in the move of the upside of this market, it was starting to show maybe a decline in volume trends. I don't know if that's a great example, or we could look at this volume move and this leg up here and say, well, what was going on there? There is no volume relative to this period here. So bottom line is, I think volume is it's a subjective term when you're saying I'm comparing today's volume. And if you take a look at this is Home Depot, and again with today's movement, the volume was the greatest in, well, since sliced bread, or at least going back for this chart. Um, and so in fact, the double checking here. This is September of 20. So bottom line for the what you see on the chart, and I'm going to change this over to a bar chart. I'm going to squinch the data in a little bit more and see if I can get some more time out of this. I think this is probably at least going all the way back to pre-pandemic levels. This is November of 19. This is probably one of the I would have to say, without doing much more research or tying it up, it appears to be one of the heaviest volume traded days in, well, at least the last few years that I remember. 18 million shares on Home Depot. It's a heavy. It was a mass liquidation. So, what's the moral of the story? Something caused that stock to go down, and this is relevant to your question. What do you do with that stock after a wide range day like today, a mass liquidation? Do we assume that we're going to see this type of volume? It's a one over event. The assumption would be that after these big old events and when the liquidation is done, volume's going to shrivel because people are either long and they're not going to come back into that. So how do you trade? I guess the answer is, how would you trade that particular instrument? So this is a case study of one stock, and you would say, John, it looks like a massive liquidation occurred. It looks like it was one of the heaviest volume traded days that I see in at least 3 years. And what would be the next course of action? You're probably going to see, if you don't see any follow through tomorrow, I doubt people are going to follow through. Follow through meaning another down day like today, a 9% downside day. It would be, the odds are there'll be maybe some more latecomers that would say I'll wait for a rally to liquidate. The moral of the story is, after heavy volume days, the next day you might see a lower volume period. So what's the answer? How do you trade low volume days? Um, you wait, and the moral of the story is you develop another strategy, or you look for another market to trade. And what's the other strategy? If the market had a liquidation of the downside on heavy volume and it just sits here, there's no more liquidation to come. People aren't, maybe they can step in and want to buy this stock. It depends on what the perception of value is. Anyone with their right mind that's not been in Home Depot and looks at where it says it was at 420, and that's off 25% of its highs in just the last, say, 7 weeks. How many people, and that's the assumption, how many people are going to say, gee, I missed buying it at 420. I love it right now. Let me jump right in it. So you're probably going to be seeing a period of contraction in the volume and participation of this stock. And so how would you trade that? Directionally, it's going to be a tough movement. You would say, maybe I'll sell some wide iron condors, and if you're an option, and that's another topic. But you would probably say, well, let me move on to a different product, right? So until volume comes in, this was a mass liquidation. And I'm going to take a look at a different stock for you, because when you could talk about the overall market, or you could talk about just in general the commodity markets, but I'm using stocks because it just happened to be the first thing that's on our screen. I like to look at this case study of Sam Adams because this is a fantastic chart, and maybe a precursor, a harbinger of what came. was when people on the media and the news had perhaps the CEO on a financial TV show and said, "Hey, we love this company. It's great, and they got this new product coming out." Well, a stock that goes from 1,300 to $382 in the same calendar, or not the same calendar year, but let's just say in less than 11 months is it a what we would say an abortion. But the point is when the stock, look at the volume levels, right? So I don't think the answer is do you stop trading something in a low volume? As long as the price is moving, you can adjust your strategy. Low volume suggests that there's not a lot of participation. And also when it comes to a stock, another aspect that you consider is maybe the stock is so damn expensive, not many people can trade it. So you have to look at what the issue is. Is there no volume, or was there heavy volume because it was a mass liquidation? Is it low volume because the stock's too damn expensive and no one can trade it? So it's kind of like the answer to your question depends on the product, and it depends on, again, price movement. Is there any price movement? And that's the better thing, because again, with volume you can have accelerated moves with no volume, and you can have big participation moves with big volume. So bottom line, I think that the answer that you're looking for is just like all technical analysis or any other question, it's subjective to change without notice, right? I mean, I don't mean to be a wise guy, but the moral of the story is you have to look at the underlying condition and see what's going on. Is there no volume because it's too risky? Is it no volume because there's too many wild swings in the market? Is it no volume because, well, it's too damn expensive to trade? And if those answers are yes to all, then look for something else to trade as a trader that mirrors within your risk tolerance. I guess that's the best answer that I could give without having, as a generalization. All right. I hope that was something that you were looking for. I don't think because volume just in the holidays, for example, we've seen during the holidays, we can see exaggerated moves because there's no one there to take the other side of the trade. People bid it up, and you can see wild swings in the commodity markets. We for decades saw this in the financials, especially the bond market. I can personally attest to this as a bond trader in the days of old. That holiday between Christmas and New Year's, a lot of people would say, "Hey, wake up one day. I'm on vacation from home, and boy, I want to start learning how to trade." And so people would come in, and it'd be holiday markets. Institutions weren't around, and markets would move and would have exaggerated moves because it was thin market conditions. So what you have to understand is it thin market conditions because of a holiday event? Is it thin market conditions because the price is too expensive? Or is there general systemic overall macro market risk? Like right now, we're in a geopolitical issue. We don't know what the ramifications are, despite the fact that Russia has invaded Ukraine. We don't know what other financial ramifications could occur down the road. We've got something even greater to concern with, and that's the Federal Reserve will be raising rates. Again, how much? A half or a quarter point? There's systemic market risks inherent to the market overall right now. Anyway, all right. Hopefully that made some sense. In general, I think you have to look at the overall condition of the market and the product that you're trading, and then what is thin market condition. If you're comparing in the SPY or the S&Ps, if it starts to narrow relative to the last 6 weeks, where we've had insanity in volume levels or in volatile periods with, like today, for example, 1.5%, 2% market value swings. I mean, consider this: 20 years ago, the S&Ps, if they moved 6 to 7% a year, that was a big ass move, right? We're seeing 2% in a day. I mean, I put that in perspective for some people. They go, huh? I go, yeah, consider this. If you could make 8% on your money, I mean, the market went up 8% in a year. That was pretty wild. We're seeing 2 and 3% every other day. So that type of volatility is hard to manage on big size. So when there's huge volatile swings, traders tend to, and you have to reduce your position size. Otherwise, you may be your career of trading could end in like a couple days. All right. I hope that it was more condition. I like the question. It's hard to answer because without saying, what do you do in a low volume market environment? As long as there's price swings, maybe it was a one over. What is causing that volume to change, or what has caused the market or the volume to be lower than normal? And that when you get that, when you say, well, it could be attributed to XYZ reasons, when XYZ reasons change again, you're back in business. All right. Hopefully that helped you, and a good lesson about volume. And again, I've got besides the relative strength PMC indicator, we have on balance volume here, and we have the person volume indicator, and then we have, again, and this is still Sam Adams, the overall histogram of volume. And as always, I'm never quite sure what the histogram, as you can see, as the price starts to move down. On balance volume does a much better job. Our volume indicator, I mean, it looks disgustingly, grossly divergent, and just in a massive liquidation mode. Which is funny about Sam Adams. While we're on the subject, volume, I'm not sure what this is trying to tell you in here, but volume is picking back up. Why? Because it's no longer a $1,300 stock. It came from $1,300 and it's now $382. So people are probably thinking there's a lot of room for upside. So I'm betting that's what the volume indicator is showing us right now, and that's what the histogram is showing. There's more. You could trade 3 times the stock now, 3 shares more relative than 1 share that you could for the same money up there. So you're seeing more volume participation, and I'm going to guess there's a lot of bottom picking going on in here, as it's attracting more investment. So here's a scenario where it's the opposite. The stock was light volume trading because it was very expensive. It fell out of bed, and volume has picked up because I'm sure people feel that this stock is undervalued at $382. When we start to see, and that might explain the volume. Why is the volume up? It keeps going down, and it's not. If you notice, from 382 to 432 is not a really big deal for most, for most markets. This market coming from 1,300 relative to dropping $10 now is no big. $10 now is no big deal. I mean, this stock's down $1,000 off its highs. This is absurd. This was last April. This is Boston Beer, Sam Adams. Your cousin from Boston. All right. What I would, we've actually talked about a lot about this in the trading room too. And I think that's what you're seeing in the market. Regardless, today, up 1% relative to the overall market, the relative strength is going to start to see it's starting to improve because it's not falling as much as the overall market is now, because it already fell and it's attracting more volume. And why? Because, again, as I said, it's a lot cheaper than it was. And I'm betting that a lot of people think there's more room to the upside, and whatever negative news, it's been priced in the market. In fact, right now it's back to trading, or at least below levels prior to pandemic. So that would be an interesting one for you guys if you're interested to put on your radar screen. AFRM, speak of the devil, affirm. We were talking about Affirm today. We noticed that today's trade session brought in some decent volume, by the way. And then anytime I look for intraday moves on a stock, and then I see relative volume compared to the 10-day, because Bonnie, you're in the room and this is part of my shtick. I look compared to volume today versus the 10-day average volume. And one of the things, if you take a look at this company, which it's a pay-as-you-go, I guess that's the best way you could say, payment plan company. They linked up with Amazon and I believe also Target. Higher interest rates maybe. I don't know what the fundamental outlook would be. Consumer trends. If interest rates go up and credit cards are more expensive and people still like to buy things online or want things, they pay as you go kind of deal. Affirm is that company that will allow you to have the product up front. Of course, they'll charge you the low interest rate of Vito and Guido, I think. But in the meantime, just slightly south of Loan Shark rates, I think. I'm not sure. But the bottom line is here's a stock that today had, again, lower volume readings. The market's not really moving, and this is again a daily chart. But one thing we saw was the weekly options had something like what, close to 4,000 volume on the 40 strike calls today, which we put that out there. So how do you trade? What is relative low volume? Again, it's low volume because who in their right mind? I think the selling pressure is abated, and that's what. Uh, and I think over time, the volume is a huge topic, and I dig it. I dig your question. All right, so now that we have this on here, we're looking at another question, and this would be, I believe, Jay. This is one of your questions from a long time ago that never got answered. Mary threw this in my face. J.A. Did you typed this question a long time ago, and I never answered it. And it was, JP, is there a way for users to change time frames when using the TSI indicator? For example, when using a 5-minute chart compared to a 15-minute, or a 5-minute chart compared to a 60-minute chart. Months ago, it was November 19th of 2020. So I am going to rip it up because we've answered it. We're answering it. I don't know if I ever did answer it. And so if there's unanswered questions, Mary, she kind of got the whip out and said, answer these questions. All right. So bottom line, 10.0 is different. I'll have to share that on a video, but it's real easy to do it for 9.0, 9.5. Format symbol, you have daily, weekly. You would change your, go to format and change your time frame. There's two different symbols, so you have to change the different time frames. So again, you go from daily, you could go from to minute, and then minute, you can change the minute right there, 60-minute bar, and then go back and change. So if you wanted to change this from a daily chart, you have to change it to 60-minute. And then if you want it, or 15-minute, for example, so you have to change each time frame independently. And I'll do another video on how to do it on 10.0. So I just want this off my desk, and I want Mary to know that I answered it. And 9.5 is slightly different, and without having 10.0 on, it makes it hard to answer that question. So that's why I said I will do an updated video. And if I don't, you send me an email and say, hey, person, you schmuck, you said you would do. Well, maybe not. Schmucks is a hard word. All right. We have, I'm reading this one here. This is JPVIP. Indicator desktop is very resourceful intensive. Yes, it can be if you have a bazillion things open. So one of the things that you probably don't want to have open as much, if you have multiple platforms, if you have Thinkorswim, if you have a lot of quotes coming through, and you have anything in this environment where markets are moving very fast and there's a lot of price action, that's a lot of data coming through. I don't care who you are, it's going to slow things down, especially TradeStation. So if you're trading algo programs, the first and foremost thing, make sure you don't have maybe the radar screen up. Whether you have it open on a different desktop or not, if you have, and I don't even have it up, a workspace up here to even show that with you. But let's say, for example, you have the radar screen up. Remember, you have your end of day futures, and if you have 500 stocks up, and then you have your intraday 60-minute, and again, if you have another 500 stocks, now you got 1,000 stocks that you're asking to be analyzed. Then you have your futures end of day and your futures intraday. Those are the 4 sub pages on the TradeStation radar screen, the main page. So if you're using an algo, you probably don't need all of that data. So one of two things: cut back the amount of stocks on your radar screen and say knock it down to a total of a 300 on the end of day and 300 on the intraday. So try not to get it under 600, or close that workspace out when you're trading an algo, and that will obviously decrease the chance for a meltdown on TradeStation due to too much data coming in this environment right now. And the environment that we have right now is, I mean, it's hard to say um, how much data is really coming through when the S&Ps are moving 1.5 or maybe 2%, and the Nasdaq's moving 1.5, 2%. That's a lot of movement. It's a lot of fluctuation. It's a lot of rapid pace of change. And to analyze all of that information is pretty hefty. Um, so what causes that resource, um, the, the resource overload? This type of movement with that amount of stocks up. And if you're think of what you're doing, and just be proactive. If you know we're in an environment where fur is flying, and you're doing one or two markets, close out the programs that you don't need right now, and maybe open them up. And if you want to see what it is at the end of every hour, if you have a 60-minute intraday system or strategy or radar screen, then close it out and then open it up, and that puts the odds in your favor, or the edge in your favor, that you're or reduces the chance of a system computer crash in this environment. Remember, this is not your normal trading environment, right? And I just thought I'd throw that in. And I mean, um, I wish I had a better answer, but that is one of the conditions that we see. Even for myself in the live trading room, that I've got multiple computers going on. The live trading room, we've seen TradeStation knocked down. It's simple. I have to close it out. I have to go and I clean out all the cache, and then I reboot, and then we're back in business. So it has been happening even to me in this environment. So is this environment, when would we see this environment stop? When could we suspect volatility will dry up? One of the and that is and I think what I'd like to point out in this, um, and this was not a question, but think it's worthy of I think it's worthy of talking about. Um, Let me try this without breaking something. Um, okay, so this is the cash VIX, and I'm going to just go back and look at a daily chart. Um, it's a couple things that are interesting aspect on this, and I will get back to what Pug meeting is all about. Pug meeting is about person's user group indicators that we use on multiple platforms. And we did have a follow-up question from last week's HDSI, which I want to get to. Real quick, if you notice that 2 weeks ago, in typical like severe market pullbacks, corrections, let's call it, we generally have seen throughout history a increase in the value of the VIX, the cash VIX, over 40. We've seen it at 50. We've seen it at 60. We've seen it, for gosh sakes, over 80 in severe market crashes. This particular correction that we've seen, the VIX, in fact, today we were like 5 handles away from the lows that we made back on January the 20, whatever it was, the 4th or 3rd hike. This high up in here, which I believe was like 39.5, or excuse me, I can actually find out the information by going here, view data window, and it opened up over here. Okay, here we go. And let's see. There we go. So on January 24th, we had a high of 38.94. I mean, bottom line, there seems to be a disconnect of fear in the market right now on this breakdown, whether it's from Russia. So there's kind of like a in two indicators that I look at: volatility as a rate of, I guess, things are moving, and also with volatility and things are moving, fear is the VIX, the volatility index. Now, things are moving, there's a different one that we like to use, and it's average true range. The average true range of everyday volatility, and no one said, and I don't think I ever covered this, so I definitely want to talk about this, is the low of the market in. And I've been using this term capitulation. We haven't seen the capitulation of the market itself. And one of the tools that we like to look at, and again, this is not a tradable item, so volume won't be relevant here. This is an index, so there is no volume because you don't trade the VIX. But we can look at the when markets start to calm down, volatility will start to collapse a bit, right? We'll start to see the market and the volatility come down. In today's trade scenario, where we had last night in the futures over our, we were down almost, what was it, almost 100 in the overnight session with the Russian invasion, et cetera, et cetera. Today was a wild and woolly market. And yet with the VIX, we're not rising and catapulting up towards 40. So there's, as I've been saying, as I said in the live room, the glass is either half full or half empty. Which is it? It's a good question. Usually when we see a capitulation, the low is in, the market has a massive sell-off, right? You get a huge spike in volatility. Every time the market posts a bottom, you see a spike in volatility, a spike in volatility. You can go back and look at this yourself. The moral of the story is we don't have that spike in volatility. And what's also interesting is the ATR is not really doing much over the last week and a half. And the ATR on the volatility of the VIX is not moving. So if someone says, John, when do you think the market's going to bottom out? We could project 4,000. We could say 401, the April low where there's a gap. But it's more like the condition of the market. And the condition of the market right now is not something that I would say is typical of a bottom. And that's the moral of the story. So I think whether it's volume or whether it's condition of the market, using either the person volume indicator is good for things that we've discussed with Bonnie, or more importantly, looking at the condition of the market, whether it's 10-day ATR, as well as what the condition of for the fear factor of the market, the volatility for going forward, looking at how it trades. Is it wild and woolly? Yes, but when the market has a blow off top in volatility, that's generally associated with a capitulation low in the S&Ps. And right now, even with today's action, it doesn't demonstrate that. So anyway, I just thought I'd throw that as a precursor to our final question, and which is, in the algo system, I'd like to check the relationship between the stop loss ticks and max trade loss. And it's a real simple question on the algo. And that is on max trade loss is max trade loss. And it will punch out any trade at your max trade loss. Stop loss ticks on an average trade that doesn't get near your max trade loss. If it adds 2 extra ticks, or it adds a couple ticks, whatever it optimizes out, it will add that to your regular stop, as long as your max trade loss isn't punched out. Your max trade loss overrides everything, number one. So hopefully that answered that question. Today is a short, and as I said, I wanted to get thanks to Bonnie and her volume question. Jay, I'm sorry, your question, I'll definitely do a video, because 10.0 is different from 9.5 on how to do that. And we have this week, it's kind of a weird week. It's a 5 days worth of work in 4, and we're traveling to the Las Vegas Money Show Traders Expo thing, but we're doing it in traveling after the market closes. So tomorrow is going to be a heck of a day. Today, I wanted to say thanks to everyone who joined us for our PUG meeting, and unusually we are cutting it short, and that would conclude today's time that I can do this. So bottom line, thanks for joining me, everybody, and we'll see you next time. And Jay, I promise I will upload a video and do a video, and I'll have Mary send it out. Thanks everybody for joining us. Thank you, Bonnie, for your question. Thank you, Jay. I'm glad I was able to have a pile that Mary said I didn't answer in previous meetings. So we do have efficiency from the top all the way down in our organization. Have a great evening, everyone. Be good.